welcome to this week's episode of Coinscrum Markets. I'm Nisa Emmanuel. Coming up, I talk to Union Square Ventures managing partner Albert Wenger about his current take on the crypto landscape. Emmanuel Marchal, managing director at ConsenSys, joins Teana to discuss their acquisition of JP Morgan's Quorum platform and product roadmap in light of EP021. And Charlie Morris is back to analyze this week's on-chain data in on-chain reaction. First, a look at this week's blockchain industry news. The Bahamas look set to beat China, amongst others, in the race to launch a central bank digital currency. Bloomberg reported that the so-called sand dollar will be rolled out nationwide in October, following a successful pilot that began last year, providing a digital payments infrastructure to many residents across its more remote islands that don't currently have one. Ukraine, Russia, Venezuela, China, and Kenya took the top 5 spots, pushing the US into 6th place in the Chainalysis 2020 Crypto Adoption Index. The report also concluded that only 12 out of the 154 countries listed had very little crypto activity at all. In what is sure to be good news for compliance officers at crypto firms across the US, the CSBS, a coordinating body for state regulators, announced that it will introduce standardized rules for money services businesses across 49 states, a move that will remove the need for firms to register on a state-by-state basis, significantly reducing barriers to entry and costs for crypto startups as well as payments firms in general. Just as progress in the tokenized securities space continues to gather steam for a number of startups, HSBC's Singaporean office published a report this week that championed the opportunities and democratization that the tokenization of assets can potentially deliver in the coming years. Citing a much earlier World Economic Forum report that predicted that tokenized assets could be worth up to $27 trillion by 2027, the authors also challenged the banking industry to collaborate in order to achieve results that are 10 times better than the status quo versus a 10% improvement that their industry might typically be satisfied with. In DeFi, the SET protocol and data provider DeFi Pulse announced a partnership that will see them launch a permissionless DeFi index featuring 10 leading tokens that include Aave, Maker, Compound, Synthetics, and Balancer on a weighted basis. And finally, longtime Bitcoin advocate and Twitter founder Jack Dorsey reaffirmed his views on the leading cryptocurrencies this week in a video post where he said he still believes that there needs to be a currency built for the internet and that Bitcoin is still the leading candidate to fill that role, given the network effect that it still maintains, whilst recognizing that there is still work to be done on the user experience and technical level before mass adoption can be achieved. That's the news this week. Don't forget to click and subscribe to our channel for more updates. Well known for being early backers of then startups, including Twitter, Cloudflare, and Funding Circle, to name a few, Union Square Ventures was also early in the crypto and blockchain game when it backed Coinbase in 2013. I spoke to managing partner Albert Wenger this week to discuss his current views on the industry and his firm's strategy for adding new blockchain-focused companies to USV's portfolio. Today, I'm delighted to be joined by Albert Wenger, partner at Union Square Ventures. Hi, Albert. How are you today?
I'm doing well. Hi, how are you?
Good, thank you. You were one of the earliest investors in this space, and I used to be your partner, Fred Wilson's lawyer, a long time ago. He used to hang out on the Bitcoin subreddit, gouging the temperature of the community before investing early in Coinbase. And you have invested directly into a number of protocol level projects. How positive are you feeling about the industry as a whole right now?
Well, this is a particularly exciting time period, I think, because there's a couple of different things coming together. One is that obviously there's been a lot of activity on Ethereum, especially in the sort of DeFi space. On the other hand, that very activity has shown some of the issues that Ethereum has today, as people are encountering, $50 gas fees, for example. That in parallel, there's a whole set of new chains that have launched or are launching, including some of the ones that we've invested in, such as Algorand launched over a year ago, but there are other things like Near and Solana. So there's a lot of activity in the space, and there's a lot of technological progress. So I think it's a very exciting moment. I also would caution that at the same time, there are a lot of people operating in the space who seem to think that somehow the fundamental laws of reality can be rewritten. I just encountered a project that was premised on there being a 1% interest rate daily. And I think there's some fundamental misunderstandings about why some things exist or don't or can't exist in the world. And so I guess I would say there's sort of a bit of magical thinking involved in some of the projects that are out there. And so it's an exciting time, and certainly one that we're following very, very closely.
Has your investment thesis evolved versus, say, 3 years ago?
Well, I think we, in the early investing, we're very focused on the infrastructure layer, so projects like Blockstack or Algorand or Filecoin, or Helium, those are all sort of infrastructure layer projects, Arweave. We do think that, the infrastructure is really now coming along. And so we are starting to look more at applications. And obviously we have some investments that have applications as well, something like Dapper, for example. Definitely feels like we're sort of on the cusp of a shift towards where the infrastructure is there. I don't think we can say it's there today, but I think one can see that it will be there. And so definitely now is a good time to really start thinking about applications and what's happening at the application layer.
So focusing on identity, which you've talked about extensively, the IRS recently announced a $625K bounty program to find a solution to trace privacy coins such as Monero, with CipherTrace saying they have had success. In the past, you've said you believe that transparency is a real opportunity we have here rather than complete privacy. Does the rise of DeFi actually play into that line of thinking as people realize the value of real-time public data across markets?
I don't know. I think this is a super, super complicated area, right? So I think that we continue to believe that end-user controlled identity is a really important piece of the overall puzzle. So if you think about your identity on the internet today, what part of it do you really meaningfully control yourself? You don't really control your email accounts. That's usually with, a Google or some other big provider. Your Twitter handle is something that Twitter controls. Domain names, I think, are pretty good, but they're complicated for most people, like registering one and then putting a site there. It's getting easier, but it's still complicated. So we do continue to think that sort of self-sovereign identity, and something you could delegate to a host, but something that you could take from one host to another host, and that you really control meaningfully is sort of a crucial enabler of decentralized systems. Now, I think the discussion around private or shielded or whatever you want to call them payments is a whole other important and I think very complicated discussion. And the reason I say it's complicated is because we're in this time period where people, I think, rightly are concerned about the power of government and whether government will and is abusing its power. And we're rightly concerned that, even in the US, we may be slipping ever further away from a democratic government and from a government where you can rely on separation of powers, where you have a well-functioning judicial system, into one where, these things are not there. And in that kind of world, the ability to make shielded payments becomes very important as a way of citizens protecting themselves from the state. On the other hand, I think it's very well understood and has been for a long time that, cash doesn't just protect citizens, but it also makes government corruption, for example, much harder to trace, right? And so I think many of the advocates of shielded payments, unfortunately, always only tell one side of the story. And the other side of the story is that this also facilitates corruption. So I think the answer is it's very complicated. And I think anybody who goes, the answer is obviously X and we should obviously be doing Y, I think is sort of either intentionally or erroneously painting a picture that doesn't capture the complexity of the situation.
And any role you think that what's happening now in DeFi and the rails being built can help with this?
Well, I think that within DeFi, there's, I think, projects that are really interesting, and we're investors in Uniswap, and obviously there was, been a real interesting sort of drama around Uniswap and SushiSwap and so forth. But I think the interesting aspect is that we're beginning to understand now that the native version, meaning that native version for blockchain of how a problem is solved, may not look like the same problem is solved in the centralized finance world. So I think early on, a lot of people thought the way to provide liquidity is to replicate many of the things that we find in the centralized finance world. So you replicate an exchange, you replicate an order book. And it turned out that because of the different and more powerful, in a way, primitives available on a blockchain, it turned out that on-chain liquidity can be provided in a more native fashion. And I'm not suggesting that Uniswap is the only project that's doing that. There are definitely other projects also. But that, I think, is kind of a breakthrough. It's a breakthrough in a broader sense, in the sense that we're beginning to understand that this isn't about copying the existing institutions. This is about creating truly new ones. And this is a little bit, this is a history that repeats itself in technology, right? So early television was filmed radio until people figured out how to do actual television shows. And so in a way, I think early crypto was, we need an order book and we need an exchange. And then now I think crypto is coming into its own, where it's like, hey, there's a totally different way of doing this that's actually more powerful and more native to the capability set. So I think that's a very exciting development.
And who do you think, if some of these projects end up having some losses or retail investors get hurt, who should be liable? Should venture investors be liable for the projects they're backing?
Well, I mean, in general, in the US, our approach has been to have a corporate shield, right? And so liability extends to investors only, for example, in cases of fraud, and even in cases of fraud, extends to investors only if they were part of that fraud. So I do think we have a legal framework for this, but I think it does speak to a broader question, which is always the question of, what is the ultimate recourse here, and where do you want to draw the line on recourse? And do you want, I mean, this is a discussion that goes back to the DAO and the DAO hack, the draining of the DAO. And again, I think, there's some people who are like, well, the code is law. And so if it doesn't work, it doesn't work. And if you lose money, you lose money. So it's, caveat emptor. It's all, the risk is pushed out. And I think that over time, we will find a balance. One of the things that I think is super interesting, for example, is to tie it back to the discussion we just had, is, are there native insurance solutions? So again, I think, people have first thought about this as let's bring traditional insurance schemes into crypto. But I think the more interesting question is, just like Uniswap represents a native version of on-chain liquidity, is there a native version of on-chain insurance? I have no idea what that would look like, by the way. I'm just saying that I think is the line of thinking that we need to engage in, rather than the thinking that insurance is bad altogether, or it can't be done, or bringing in sort of an outside non-crypto insurance scheme into it. So I think there's still a lot of innovation that needs to be in place for this to be really broadly and widely adopted.
And we've seen Nexus Mutual and other iterations happening in that regard already. So yeah, I agree. So talking about the devastating wildfires that are going on in the US right now, and they happen in Australia earlier in the year. And we've spoken about the many ways that blockchain can be used as a tool to combat climate change. What do you think about that? Can more seamless markets, the type you can imagine DeFi innovators building, deliver highly efficient energy markets, or can the convergence of IoT and blockchain detect climate change and then have smart contracts reward via crypto some reductions in greenhouse gases? What are the ways that we can use this technology for good?
Well, I think it's always good to go back to first principles and sort of say, what is a blockchain actually good at? And what it's good at is, permissionless consensus, right? So anybody can join a consensus, anybody can join essentially a database if you so want. And so from there, we can sort of ask, what are some interesting applications for that? And I think the market for carbon offsets is a really interesting potential application for this. This is a market that has a lot of issues, and blockchain in and of themselves doesn't necessarily magically solve them, but it can form a new system where people can register offsets, and where you can see, for example, let's take forest, where you could sort of make it very clear that a certain set of trees has actually already been sold. So I'm not selling the Brooklyn Bridge, to 7 different buyers, right? Now, it doesn't solve all problems, because there's still the issue of, do I even own this forest and have the right to sell it? That's one, problem that one needs to understand. And the other thing is, what's the ongoing monitoring? So, I say I have a bunch of trees here, I post a nice photograph of it, and then, I sell it, and next day I cut out all those trees down. So there's certain problems here that I think blockchain can solve, such as sort of creating a system where you don't have some complicated global process where people need to be vetted and joined. But conversely, if you have an open system that people can join permissionlessly, then you need to deal with so how is ownership established? It goes back to the identity conversation we had earlier. How is ongoing monitoring? So which ties to the whole more general Oracle problem. So how do you, and I think there are solutions for all of these things. So for example, you could envision something where people who analyze satellite images, where they sort of attest to those trees actually still being there with some frequency. And you can envision a system where they need to stake, and if somebody else can present credible images that show that those trees are not in fact there, then maybe their stake is slashed. So but again, I think much as in the earlier discussion, these systems will take a lot of thinking, a lot of iteration, a lot of getting it wrong, and they're not going to be trivial systems if they are really truly addressing the problem.
Well, Albert, thank you so much for being with us today. So great to hear your insights, and appreciate you taking the time.
No, my pleasure. I really enjoyed this.
The blockchain landscape has changed considerably since Ethereum co-founder Joe Lubin launched ConsenSys as the commercial software development and venture studio for Ethereum. With sentiment changing towards public blockchains over the past year, along with their recent acquisition of JP Morgan's Quorum, Teana was joined by their managing director, Emmanuel Marchal, to speak about the deal along with their plans as they migrate towards ETH 2.0.
Thanks, Nisa. I'm delighted today to be joined by Emmanuel Marchal, Managing Director and Global Head of Sales at ConsenSys. Manu, thanks so much for joining us today.
Thanks a lot, Tina. Really glad to be here.
No, it's such a pleasure. So let's kick off with the most recent ConsenSys headline, if you will. ConsenSys just bought the Quorum platform from JP Morgan. JP Morgan had developed it, and you've also become a strategic, and they've become a strategic shareholder of ConsenSys. So pretty exciting news. Can you tell us a little bit about this deal and how it came about and why it makes sense for both parties?
Yeah, absolutely. So on August 27th, our company ConsenSys acquired the Quorum platform from JP Morgan. Quorum, as you probably know, is the leading platform for private permission blockchain networks. And we will merge the technical roadmap with our mainnet compatible client, Hyperledger Besu. And so combining this roadmap will be a powerful offering in the enterprise Ethereum space, especially as we see more convergence on mainnet Ethereum.
Yeah. So with all eyes on, other areas such as DeFi, companies such as ConsenSys have kind of fallen out of the limelight a little bit, but you've quietly been, really working away. So going back in time a little bit, ConsenSys launched pretty much at the 2016, 2017 enterprise blockchain, start. And then I think the thinking was more that enterprise blockchain was quite a long way off, considering public blockchain. So you've scaled up super quick since then. And then, at some points, given the market, had to scale back down a little bit. So, give us a quick lowdown on what it's been like at ConsenSys over the last couple of years, and how you've positioned the business given the changes of sentiment toward public blockchains that we've seen over the last year.
I think it's been a really exciting 3-4 years. So for ConsenSys, I think to tie that back to the announcement, it's really the culmination of an 18-month transition for ConsenSys. We have restructured and separated our investment business from our software development business, which allowed us to be really hyper-focused on building out our product suite of tools, infrastructure, and application for Ethereum. Our products enable developers to build the next generation applications. We work with enterprise to launch modern financial infrastructure. We also have been helping people use the increasingly decentralized web. And so today, our product suite serves millions of users, support billions of blockchain-based queries for our clients, and that has handled billions of dollars of digital assets. So we've gone a long way. Today, we have our software business is super focused on our core products, which are Quorum, Infura, Codify, MetaMask, and Diligence. We have also other products that used to be developed in ConsenSys, and they now sit in a separate portfolio, and we'll have more to share in the structure of that portfolio in the coming weeks.
Mm-hmm.
But that transformation was really a critical step in enabling ConsenSys to continue to drive innovation, better serve its customer and the broader ecosystem.
Yeah, well, I think many of our viewers will know of ConsenSys both as a software development studio, as well as an investment firm, funding the Ethereum ecosystem. So, how much weighting between the two, kind of roots to business has shifted over time?
I don't think it has shifted. Maybe it has shifted in the eye of the market or the press, depending on the hypes or the hype cycle in the space. But for us, it's always been very clear that there's two markets that are converging. The enterprise market, which has been very early on in 2015, started understanding the benefits of blockchain for streamlining operation and reducing complexity and reducing cost. And then the whole DeFi space, which had iterated through many different names, or the Web3 mainnet space. And we've seen demand on both sides. We know eventually these two spaces will converge. Earlier this year, we've announced jointly with EY the Baseline Protocol Initiative, which looks at using mainnet for connecting enterprise ERP systems. And so that convergence is definitely happening. And so we think we are in a very exciting position in the market, given our involvement in both the Web3 and the enterprise blockchain space.
I think, ConsenSys compared to companies like maybe Hyperledger or Corda, ConsenSys has always kind of promoted that vision from the start that public and private blockchains would ultimately merge or converge and become interdependent in some way. Do you think that this more liberal mindset is filtering through? And if so, what kind of competitive position does that create for ConsenSys?
So when it comes to blockchain, I think you need to look at it as, and what we see is today, Ethereum is the largest programmable blockchain in the world. It's leading in business adoption, in developer community, in growth, in natively digital and decentralized finance. And for example, this summer, we've seen the daily transaction fees on Ethereum surpass those of Bitcoin, meaning Ethereum is the most used protocol. That's really what it means. And every time there's been a technology that saw a mass adoption, it's always been stretched to the limit. We'll remember complaining about internet being too slow, which meant really that internet was successful. And so the same is happening here. Blockchain are a trust technology, and Ethereum is far and away the leading candidate to serve as the new trust foundation for the payment system. And so we are really, really exciting about our positioning in the space and how we can support the continued growth of the ecosystem.
Yeah, so let's talk about, what's next. There's excitement building over the upcoming release of ETH 2.0. Where do you see the opportunities that will create for ConsenSys at a software development and scaling level? Do you see opportunities around potentially staking? What could the scaling issues be? What's your position on the future outlook for the highs and lows of ETH 2.0?
Well, we see the high. So Ethereum 2 has been, a long way to come. The community has poured an incredible amount of effort in making sure Ethereum 2 will be right from the start. And therefore, it's making sure that, there's sufficient tests and but Ethereum 2 was talked about already in 2015 with the move to proof of stake. For us, with ConsenSys, we've been involved in that in this journey from the start. Earlier last year, we started releasing our Ethereum 2 client called Teku. We've also earlier this year launched our staking service called Codify Staking. And we see a tremendous level of interest as everybody is now starting to line up for what I really hope a launch of the Bitcoin chain towards the end of the year. And so we're ready for supporting this.
Okay. How confident are you that Ethereum 2.0 will help to solve, some or all of the network scaling issues that it's experienced?
I'm very confident. I'm very confident because not because we get the silver bullet on technology, but because Ethereum benefits from having the largest community adoption and support, the largest amount of research around it, done not by a single company, but by a combination of companies and independent developers. And as such, and it has proven this over the last 5 years, is it's capable of innovating, yet maintaining the security and solidity of the existing network. And so very, very confident that continue to operate on in that way. I think that's also a very interesting trend in enterprise is the increasing level of adoption of Ethereum, not only in traditional enterprise consortiums, but also with central bank digital currencies. ConsenSys is in discussion right now with 4 of the central banks for the issuance of digital currency. And so that's another trend of the adoption of Ethereum in the space.
Great. So, one of the other, surrounding issues, that we talk about a lot is interoperability cross-chain, right? So, there's teams like Lab 577 who are building on Corda but remaining chain agnostic, or projects like Polkadot or Cosmos. How do you see the next stage of interoperability playing out? And how important are things like standards? What role do they play in ensuring that interoperability becomes a reality?
Yeah, so interoperability is going to become critical, but first you need adoption on networks. And so what we see today is most of the digital assets are existing on Ethereum, and in private network, recent report showed that it's a two-pronged race between Fabric and Ethereum, with Corda following next. And so that means the assets, interoperability will be important, but the first prime is making sure this network gains significant traction and exists, and then interoperability will come next. I think what we've seen so far is on the interoperability work, there's standards are going to be critical, which is why we've been involved in the formation of the Enterprise Ethereum Alliance that has worked on standards for Ethereum technology and also smart contracts. We're involved in the token taxonomy framework, which is another group that's trying to establish standards of digital assets. And also all the ERC 20 and 1400 and different Ethereum standards are very important. So we are highly involved in all of these. And then I think this will naturally set one of the foundation for where the interoperability will be important.
Okay. Well, and I guess finally, one of the questions I wanted to just touch on too is, what are your other core areas of focus or demands that you're seeing from enterprise services or enterprise customers? We don't hear as much about what's happening in the enterprise space. Where do you see the next kind of 12 months and the evolution of enterprise blockchain going?
That's a good question. So maybe enterprise projects are a bit less sexy than DeFi right now, but they're very real. So for example, in the global trade and logistics space, there's very significant projects that have taken place, going live in 2018 and growing now to hundreds of customers, like of Congo for commodity trade finance, or Coinscrum for post-trade processing, or VACT also for post-trade processing in oil and gas. All these projects have gathered hundreds of customers and have now effectively digitized the operation of their market between counterparties and have become references in their respective markets. So this will continue. We will see many of these networks still coming live this year. And then I think gradually you will see a consolidation of these networks or a connection of these networks. So for example, VAT, which deals with trade execution in oil and gas market, is connected to Congo when it requires financing. And so that's one form of interoperability, although both of them are built on private Ethereum. It is two separate chains, and there's interoperability between the two. So I think we'll continue to see this. I've talked also about central bank digital currencies. These projects are becoming very real. We've seen a massive progress this year in the adoption. The European Union just announced that it needs to accelerate to not be left behind China on its digital currency initiative. And then I think next year we're going to start seeing some of the first convergence project where enterprises are using mainnet to interconnect their systems. And that will be, again, very exciting development. Fantastic.
Manu, it's been fascinating. Thank you so much for giving us a little bit of an inside view of what's happening at ConsenSys. It's been a pleasure to have you.
I'm very, very glad to have that chat with you today. And thank you for the opportunity.
It's a pleasure. Back to you, Nisa.
Next up, Charlie Mars joins Teana for this week's on-chain reaction.
Thanks, Nisa. I'm back again with Charlie Morris from ByteTree. Charlie, thank you so much for joining us again.
Pleasure to be here on this fine day.
Yes, it is a great day, isn't it? So we're going to talk a little bit about the Bitcoin macro view as it relates to on-chain data. And I know you have a couple of interesting stats for us. So let's kick it off with a new methodology to capture transaction value.
Sure. So what's happened here is that we created our first transaction value number back in August 2014. So, we were kind of looking at, wondering at what point we should do some service on this anyway and see if we should update our methodology. But as luck would have it, there's been some interesting traffic trends over the summer, and some privacy coins have, gone bananas. And what you've had is different types of transaction evolving over the years. And so people are using the network in different ways. For example, it costs more to send a transaction these days than it once did. People used to think that sending transactions was virtually free at one time. People talked about micropayments, but now, we sometimes see, hefty numbers, more than a round of drinks to send a Bitcoin transaction. So, that can happen. So we're seeing bunching of transactions together. We're also seeing demand for privacy. And in that sense, people put all their money together and kind of treat it as one. So it's very hard for the regulators trying to understand what belongs to who. And so some of this sort of traffic was obfuscating our financial data. Now, the interesting thing about on-chain metrics is when it comes to something like spend, there is no exact number as to how much money is changing hands over the blockchain. You have to make assumptions and you come back with an estimate, because it's not like a bank account when exactly you started with $10, you end up with $5. There's no question that the transaction was $5. But in blockchain, it's subjective for various reasons, and that's part of the elegance of the system, because to think it probably would work with a very clear transaction if Bitcoins had serial numbers, but they don't. They have provenance, like a good bottle of wine. And for that reason, it is much more complex to do this. This is why we have powerful computers behind the scenes trying to do precisely this. But the reason why the on-chain stat is important is because effectively the network is if you think, what does Bitcoin do? It transfers value. The more value that transfers, the more the network is worth. In the same way that if you have a very fast runner, the faster they run, the more they're worth, right? And so someone doing what they do best. So that's really what it comes down to. And our new methodology strips out a lot of this fake traffic not fake traffic, but the confusing, obfuscated traffic that's been occurring over the summer, and brings it back down. You can see that in the chart. So our old data flew off in the yellow line, and we've brought it back to the blue. And I think that's really reassuring. We've had this opportunity, and it's not just the fact that we've managed to get rid of some of this traffic. We identified new types of traffic, which are also interesting. And so, on the second slide, if we can move to that.
Yeah, the complex and batch spend.
Yeah, I mean, what you've got here is the complex spend really is the attempt to look for privacy. So you've got these transactions that are much larger than they actually are economically. So there could be $100 million moving around, but actually there's only $5,000 of an economic transaction. So it's quite easy to pick up far too much traffic there. And the other one is batching. So batching can be used by legitimate organizations like Coinbase, for example, to save their customers money. They might put 100 different transactions together. So I think it's all part of the journey of trying to understand more about what's going on to the blockchain. And I suppose the bottom line is, what's the macro implication this week? Well, not much, because the data's pretty smooth. It's no change on last week materially. We're not growing, we're not declining. So I think there's not a big story there. But the fact that we've got better, cleaner data to use in the future is very exciting for us.
Indeed. So let's take a look at the network velocity for Bitcoin.
Yeah. Well, obviously, if you change the number, so you can see the methodology a couple of slides ago, the number is slightly different. And we've always said that 600% network velocity is the point at which you should be concerned about the network. If it drops below, then the price action is less likely to be strong. It's the same in an economy. People get excited and prices tend to rise when you've got money moving around very quickly. When money's standing still and not moving, you have a deflationary problem, and the economy can grind to a halt. And so it's the same. It's a simple measure. I'm oversimplifying a complex story here, but basically that's what's going on. A lively Bitcoin is a valuable Bitcoin, and a dead Bitcoin is a worthless Bitcoin. I think you stick to that simple principle, then that works well. And there's just been some crazy bullshit on the internet recently from people talking about network velocity. There was one, I won't mention their name or the news organization, but they were saying that low velocity implied high hodl, which was value creating. As if, along the lines of the stock to flow ratio, the more Bitcoins you take out of the system, the fewer there are to buy, so the price must go up. This is the biggest bullshit in the whole of the Bitcoin blockchain sphere. This idea that you start tearing up Bitcoins and destroying them and they can only go up. I mean, yes, that would be true if they represented, the Emperor's Palace in Tokyo, or a large pile of gold or whatever, but they don't. They're a network. The values of the network, the values in having many of them moving around. And so the more you take out of the network, the less value you have. So I'd say it's the other way around. And we would say, the more Bitcoins that can move, the more vibrant we can make this economy, the more money will be made. It's a very, very simple equation, and we can prove it.
Okay, so the testing velocity, highest returns, one above 600%.
Yes, I mean, as I say, we need to recalibrate the numbers slightly, but this is using the new data, and there it is. Whenever the velocity of the network is above 600%, you tend to make quite a lot of money. And in this particular chart, I'm sorry, I have to look right, but Bitcoin's up 10 times or a bit more since 2014. It's a bit more than that on the chart. It's a log scale, and it's up another 5 times. If you only were invested when the network was above 600%. And whenever the Bitcoin network velocity was below 600%, it was never profitable, ever. So you missed all that time. Every time it was below 600%, you can see on each occasion it was either flat or down. And so, the lesson is very simple. A lively network is a valuable network.
Thank you so much for joining us again.
Thank you.
I always love your very transparent and direct assessment of what's happening.
It's a pleasure to be here, and it's such a shame we're on Zoom.
I know. Well, soon, hopefully not. It'll be a pleasure to do it in person. Thanks again for joining us.
Thank you.
Back to you, Nisa.
You've been watching Coinscrum Markets. Thanks for joining us. See you again next week.